Mark, let's come to you. Let's talk about the markets in 3 minutes. The futures picture looks fairly flat in the US. We're looking at a situation that has improved. We talk about this at the top of the hour. So some of the risk aversion that we'd seen over the past 24 hours fading just a little. Things don't move in a straight line, though, it seems, and they're worth remembering that in January. What do you make of risk sentiment then as we find ourselves just over the halfway point of January?
I think that in the very short term, I think we'll see risk assets bounce from here. And I think there are a couple of dynamics yesterday that suggested that we've reached at least a short-term capitulation in sentiment. And we've got to remember, it's not like returns recently have been that bad. US stocks are just off a record high. Many other markets are very near record highs as well. But the last couple of days have been very, very tough. And I thought it was interesting that Waller essentially said nothing new. We've got to remember that the Fed have never validated 6 rate cuts this year. They've never validated a March cut. The markets were ignoring everyone. Waller changed their mind, but it wasn't necessarily new comments out there. But I think that showed that, hey, wait a sec, people have to accept that the data is not yet justifying a March cut or the aggressive rate of cuts, especially after that retail sales data we got yesterday. So I think that was an important capitulation on the bond story. And also, we saw extremely high volumes in Hong Kong yesterday at a complete capitulation. Now, I don't want to dare suggest it's the final capitulation, but as my colleague Mark Cranfield put it, maybe the first step in capitulation. And we saw really, really positive price action today, where those markets again tried to trade lower. The whole region was lower this morning, but they turned around, and it did look like it was the Chinese sovereign wealth fund that was in the ETF market, and that really helped turn sentiment around. So really, there seems to be a few capitulation points around markets that are coinciding to probably see us have a risk-positive end to the week at least.
A risk-positive end to the week. We do seem to be trading around rate expectations. Risk appetite, though, being dictated by rate expectations. So when we hear that retail sales data, we hear the pushback from the ECB officials, we look at the inflation data out of the UK, all of that led up to reduced rate cut expectations for next year, and risk assets reduce as a result. Do you sense, then, that we're getting to a point where maybe we trade around the good news, where we start to reflect on what is driving that change in rate expectations?
We're still trading this knee-jerk reaction that higher yields bad for stocks. We saw that yesterday. But ultimately, if yields are higher because the economy is very resilient, i.e. it is showing that it can cope with these higher rates, and that's why we're not going to see rate cuts, that is good news for stocks. Sure, it's short-term more difficult, but it's only going to be an earnings recession. It's going to be a real economic recession that is very, very problematic for stocks. And I know stocks are expensive, but in this world at the moment, we're still in the bigger picture of the Goldilocks scenario that we've been in since that December Fed meeting, where it's the idea that the economy is definitely not capitulating yet. I shouldn't say definitely, but it doesn't appear to be capitulating yet. Growth is slowing, but not going off a cliff. And yet the Fed is saying its reaction function is much more dovish than we thought earlier in December. And that is a supportive environment for risk assets.